Let's very quickly check in on Wall Street, which will, like we pointed out to you a short while ago, is trading flat really. On your screen is the Dow Jones Industrial Average, which is down about 0.1%. The Nasdaq Composite Index seeing similar losses, but flat really is where you are seeing the markets on Wall Street. And this is because while there is, like we've been saying, hope on the one side that the fiscal cliff will get fixed, there continues to remain a lot of concern about the direction of the economy. You are seeing some macro points which are supportive, but at the same time you continue to see bad news which doesn't seem to give a clear picture of a clear recovery in the US. In Europe, what you are seeing is green, and this is largely because of the German business confidence data which has come out for the second month, where optimism seems to be playing out on the minds of industry and investors, and that's lending support to the markets broadly over there. So the three key markets in Europe, Paris, Frankfurt and London, all in the green.
All right, George, let's keep it with the international markets and let's get an important view on that. Nick Parsons, the head of market strategy at National Australia Bank, joins us from on the show from London. Nick, good to have you on the show. Now, S&P has upgraded Greece by 6 notches. What next? A downgrade after it runs out of money again?
It's a bit of a roller coaster ride when we look at the ratings agencies. 6 notches is quite a substantial move. But then again, if Germany, as we've long suspected, is ultimately going to be forced to keep putting its hand in its pocket, then there's no reason to believe that Greece can't be sustained at or around current levels. Those people who were thinking in terms of 70–75% probability of a Greek exit have probably only got 10 days left now for those predictions to come true. They're simply not going to happen. So I think the greatest thing that we can say about Greece and the European sovereign debt crisis is it's moving away from the headlines, it's moving off the front pages, and it is really one of those classic cases where no news is indeed good news.
Now, Nick, Silvio Berlusconi believes Italy will be forced out of the Eurozone if the ECB is not given more powers to ensure lower borrowing costs. Are the markets only viewing that as a statement aimed at the Italian voter base, telling them that he is the better choice in the February elections?
It's purely domestic politics on the part of Mr. Berlusconi. The fact is that the ECB has got unlimited powers. The ECB, if it wishes, could bring bond yields down to whatever level it so chooses, because the word unlimited means unlimited, and perhaps there isn't an Italian translation of that word available to Mr. Berlusconi, but he should know that if the ECB wishes to get Italian 10-year down to 3 or 3.50 or 3.75 from its current 4.4%, then it is entirely within its power to do so. So this is domestic politics. The markets haven't taken a great deal of notice of Mr. Berlusconi's comments, and the fact is that as we speak, Italian 10-year yields are down another 6 basis points on the day. So I think that scare too will also pass.
So Nick, what's your view on the markets for 2013? Do you expect equities will turn in the same kind of performance that they did in 2012, or are you more optimistic?
I think a weak dollar will help support those large corporations that are based with US quotations. So I think the S&P and the Dow are going to hold in fine, and I think there's going to be a move out along the risk spectrum towards emerging markets, because that's where the growth is going to come from. So we would expect EM equities to outperform developed equities, but we see the equity universe as a whole looking pretty set fair for the first quarter of 2013 at least. And I think for a tradable, investable horizon, that's as long as one would reasonably wish to have a view. So the first quarter looks set fair, and I think where investors are still significantly underweight relative to the benchmarks, the only way to get from underweight to neutral is by buying into this market.
Nick Parsons, thanks very much for joining us on the show with your outlook for the global markets going into 2013.